Two people, same apartment complex in Charlotte, same floor, both 29. Both working project coordinator roles in different companies, both pulling in about 68,000 a year, both staring at the same housing market. One of them signs a purchase agreement in June, puts 10% down on a $390,000 house, accepts PMI. The other one keeps renting, keeps saving, wants to hit 20% before signing anything. Same starting line, same city, same paycheck, one choice between them. 20 years from now, the gap between these two people is not what you think it is, and it does not favor the person most of the internet says it should. The house cost $390,000. The 10% down buyer puts $39,000 on the table. That leaves a loan of $351,000. At this week's 30-year fixed rate, 6.37%, according to Freddie Mac's primary mortgage market survey from April 9, 2026. The monthly principal and interest payment lands at $21.89. But that is not the full number. The 10% down buyer has a credit score of 738. According to the Urban Institute's Housing Finance Policy Center, the average annual PMI premium for that credit score bracket at a 90% loan-to-value ratio is roughly 0.7% of the original loan amount. 0.7% of $351,000 is $2,457 a year. Divide by $205 a month on top of the mortgage, on top of the taxes, on top of the insurance. $205 a month to borrow the money you did not have yet. Now, here is the thing most people never calculate. They see $205 a month and they think about it in isolation, like it is a permanent scar on the loan. It is not. PMI has an expiration date. Under the Homeowners Protection Act of 1998, your lender is required by federal law to automatically cancel PMI once your loan balance hits 78% of the original purchase price. You can request cancellation even earlier at 80%. On this particular loan, on a standard 30-year amortization schedule, that automatic cancellation hit somewhere around year 9. The borrower requested cancellation closer to year 7. So the real question is not how much PMI costs per month. The real question is how much it costs in total before it disappears. $205 a month for roughly 84 months. That is $17,220. $17,000. That is the number everyone fixates on. That is the number every Reddit thread screams about. And that is the number that by itself tells you almost nothing. Because here is what happens on the other side of the hallway. The 20% down saver stays in the same apartment. Rent is $1,400 a month. The plan is straightforward. Keep stacking cash until that down payment hits $78,000. Already saved $39,000, same as the buyer, needs another $39,000, at a savings rate of about $1,000 a month. That is roughly 3 years and 3 months of continued renting. No vacations, no new car, just the number climbing. You have been in that apartment on a Sunday afternoon. The light comes through the blinds in stripes across the carpet. The fridge hums. You are sitting on the couch with your phone, and you open the savings account, and the number is 31,000 and something. And you do the math in your head for the 400th time. 39 minus 31, 8 more months, maybe 9. You close the app and stare at the ceiling for a second. That is how saving for a down payment actually feels. Not like a strategy, like a holding pattern. But 3 years and 3 months is not just 3 years and 3 months of patience. It is 3 years and 3 months of rent payments. 1,400 times 39 months. That is $54,600 paid to a landlord. Gone, not building equity, not appreciating, just gone. And that is only half the cost. The Federal Housing Finance Agency's House Price Index shows that U.S. home prices rose 1.8% year over year through the fourth quarter of 2025. Published February 2026. The Bureau of Labor Statistics reported that shelter inflation ran 3% year over year through March 2026. That means the $390,000 house the saver is waiting to buy is not sitting still. If home prices keep moving at even a conservative 2% a year, that house costs $397,800 after year 1, $405,800 after year 2, $413,900 by the time the saver has the full 20%. The saver finally has $78,000 in cash. But the house now costs roughly $414,000. 20% of $414,000 is $82,800. The goalpost moved. The saver is still short. Think of PMI like a toll bridge. The buyer in Charlotte paid $17,000 to cross the bridge right now. The saver is swimming around the bridge to avoid the toll. But the river is getting wider every month. And every month in the water, rent is pulling cash out of their pockets. Nobody talks about this part. Everyone adjusts quietly. The saver recalculates, extends the timeline another 5 months. Rent keeps going. Home prices keep moving. The saver finally reaches the target at roughly month 44, 3 years and 8 months after the buyer already closed. In those 44 months, the saver paid $61,600 in rent at the original flat rate. But rent does not sit still either. Total rent paid by the saver during the waiting period, factoring in annual 3% increases, comes closer to $64,000, not a dime of equity. The saver also missed 44 months of mortgage amortization, 44 months of principal paydown that the buyer was quietly accumulating. On the buyer's loan, in those first 44 months, roughly $29,000 in principal got paid down, not by magic, by the regular monthly payment the buyer was already making. So the saver avoided $17,000 in PMI, but the saver paid roughly $64,000 in rent, and the saver missed $29,000 in equity accumulation, and the saver's eventual purchase price is $24,000 higher than the buyer's purchase price. I am going to be honest, I did not expect the math to tilt this hard. I figured PMI was bad, but the waiting cost was also bad, and it would be close. It is not close. But here is the part that really breaks it open. The buyer, the one who accepted PMI, has been living in the house for 44 months already, making payments that are part interest, part principal. And here is the critical thing, and this is all public data, public math, not personal advice for anyone's specific situation. But the numbers tell a story that is hard to ignore. By month 44, the buyer's remaining loan balance is about $337,000. The house, appreciating at the same conservative 2% annually over 44 months, is now worth roughly $419,000. The buyer's equity is about $82,000. The saver closes on a house that same month, puts down $83,000 on a $414,000 home. New loan amount $331,000. Starting equity $83,000. So at month 44, the buyer has about $82,000 in equity. The saver has $83,000, nearly even. But the buyer got there by paying into a mortgage for almost 4 years. The saver got there by handing a landlord $64,000 and then writing a bigger check at closing. You are at the kitchen counter. It is morning. Coffee is still too hot. You pick up your phone and open Zillow not to buy anything, just to look. You type in your zip code. You see what the house down the street is listed at. You know what you paid for yours. You do not tell anyone you do this. Everyone does this. The person who bought early is doing this too. But they are doing the math from the inside. The saver is doing the math from outside, watching the prices scroll. The toll bridge, the buyer crossed it at $17,000. Now let us see what the river costs. By year 10, the buyer's home, appreciating at 2% annually, is worth roughly $475,000. The buyer's remaining mortgage balance is about $281,000. Equity, $194,000, and PMI has been gone since year 7. The monthly payment dropped by $205. That freed up cash has been redirected into the mortgage or savings for 3 years. The saver's home, purchased 3 years and 8 months later at $414,000 with 20% down, has appreciated for about 6 years and 4 months. Value, roughly $468,000. Remaining balance, about $273,000. Equity, $195,000. Nearly identical at year 10, the saver caught up barely. And only because the saver put down a much larger pile of cash at closing. But here is where it gets personal. The buyer has been living in the house for 10 years. The saver has been living in the house for 6 years and 4 months. The buyer had 44 more months of not paying rent, of building credit history on a mortgage, of having a fixed housing cost while rents around Charlotte climbed 3% a year. By year 10, the comparable apartment that was $1,400 is now over $1,900. The saver paid escalating rent for nearly 4 years while waiting. Total rent paid by the saver during the waiting period, factoring in annual 3% increases, roughly $64,000. Let me say that one more time, $64,000. To avoid $17,000 in PMI. Somebody made money on this decision. The landlord collected $64,000 in rent that would not have existed if the saver had bought earlier. The lender would have collected $17,000 in PMI. The saver chose to pay the landlord $64,000 instead of paying the insurer $17,000. And every financial advice forum on the internet told them they were being smart. Now fast forward to year 20. The buyer's home at 2% annual appreciation is worth roughly $579,000. Remaining balance on the original loan, roughly $142,000. Equity, $437,000. PMI has been gone for 13 years. The monthly payment has been the same fixed amount since day one. While the saver was renting, the buyer locked in a housing cost that inflation cannot touch. The saver's home, now owned for 16 years and 4 months, has worth roughly $562,000. Remaining balance, about $191,000. Equity, $371,000. The buyer, $437,000 in equity. The saver, $371,000. The gap is $66,000. The person who paid PMI is $66,000 ahead of the person who waited. Not because they were smarter, not because they got lucky, because they paid $17,000 in temporary insurance to stop paying $64,000 in permanent rent. Because 44 months of early equity accumulation compounded for 2 decades. Because a $205 monthly PMI charge was smaller than the $1,400 monthly rent it helped them escape. The toll bridge cost $17,000 to cross. Swimming around it cost $64,000 in rent, $24,000 in higher purchase price, and 44 months of lost equity. The bridge was cheaper. It was always cheaper. Most people just could not see it from the parking lot. By any reasonable standard, the person who waited did what every personal finance subreddit says to do. Save 20%, avoid PMI, do not borrow more than you need to. And every one of those decisions seemed right at the time. The total cost of that patience was $66,000 in lost equity compared to someone who just paid the toll and kept moving. This is not about being reckless. This is not about putting 3% down on a house you cannot afford with a credit score of 620 and hoping it works out. That is a different math problem with a different answer. This is about a specific scenario with specific assumptions. 2 people, good credit, stable income, 10% saved, looking at a $200 monthly PMI charge and wondering if it is worth it. Individual situations vary widely. The interest rate you lock, the city you buy in, how fast that city appreciates, your job stability, your other debts, all of these change the math. Run your own numbers, or better yet, sit down with a licensed mortgage professional who can run them for you. The apartment is quiet tonight. The fridge still hums. The light from the phone screen is the only thing on. $205 a month for 7 years to own something that grows while you sleep. Now, I am not telling anyone to do any of this. But here are the levers that exist in the system right now. The first lever is timing. PMI on a conventional loan is not permanent. It is finite, countable. On most loans, it vanishes in 7 to 9 years. Sooner, if the home appreciates and you request early cancellation with a new appraisal. The second lever is the rate itself. A credit score above 760, according to the Urban Institute's data, drops the annual PMI premium to 0.46%. Between 740 and 759, it sits at 0.58%. Every point of credit score improvement before closing is real money saved over the life of that insurance. The third lever is the LTV starting point. 10% down versus 5% down is not just a smaller loan. It is a lower PMI rate, a shorter PMI duration, and a faster path to 80% equity. The math between 5 down and 10 down is not the same as the math between 10 down and 20 down. The project coordinator in Charlotte who put 10% down is refinishing the deck this spring. The one who waited is still in the apartment. Same paycheck, same floor, different side of the math. You are not bad with money. The advice was just incomplete.